All right. So walking through kind of the general rules of Section 1202, most of these cover the historical rules as they've been enacted since 1202 was first enacted in the early 90s, but we are including obviously some of the updates that were made. And basically, generally is for those of you who are familiar with 1202, the rule is that non-corporate taxpayers, so individuals, partnerships, certain kinds of trusts, and other flow-through entities, may exclude a portion of the gain or sale from qualified small business stock that's held for more than 5 years. And that was the historical rule. It was 5 years, all or nothing. You either met that or you didn't. Obviously, there's been some changes, but for stock that you probably are dealing with today, it's a 5-year holding period. And so, and when 1202 was first enacted, you were only allowed to apply your limitation to 50% of the proceeds that you got from the sale of stock. So you were still able to get your full 1202 exclusion amount, but when you sold your stock, you basically had to say, okay, I can only apply my exclusion 50% of that. And that increased to 75% of proceeds for QSBS that was acquired on or after February 17th, 2009, and before September 28th, 2010, also with AMT limitations. And then or on or after September 27th, 2010, it was able to be applied to 100% of your proceeds and no AMT limitations. So yeah, good.
I was going to say, it's a very sleepy provision. It's been on the books since 1993. Really, QSBS has become a big deal in the last 10 years because originally the 50% gain exclusion was not very valuable because the other 50% is taxed at a 28% rate, kind of via quirk of the statute. So your blended rate was 14%. Capital gains rates right now are 15 or 20%. So it's very limited benefit. So it ended up not being a big deal for a long period of time. It became a very big deal once we have 100% exclusion. And so most of that stock started to reach its 5-year hold in 2016, 2017 forward. And so it's become a much bigger deal the last 8, 9, 10 years. Whereas even though it was on the books for the first 20 years, really not very many people paid attention to it because of the 50% exclusion.
Yeah. And I was going to say too, probably the passage of the TCJA lowering corporate tax rates significantly, probably helped and encourage people to choose a C Corp structure as well. So it's kind of a two-pronged benefit there. And as we were saying before, as part of the O3Bs, the new tax rule, the new tax bill for stock that's issued post July 4th, 2025, there are some kind of new provisions and new rules that are important to take into account.